What's going on, guys? Alright, yesterday, Don from the Daytradeshow, he did an interesting video. It was labeled Interest Rates, the Brand New Thing Again. If you have not seen it, go see it. I will place a link below so you guys can check this link out. Or you could just type in the Daytradeshow on YouTube. But anyways, what did Don say? Don stated that we're going to see higher interest rates come on about. Initially, that may cause some headwinds within the stock market, but eventually this is going to create an economic boom in his scenario because of fractional reserve lending, and since we have all this money that's been printed by the Fed, the banks are going to lend it. When interest rates are higher, they're going to lend it, and then you're going to create an economic boom. But then the problem is you're going to have nasty inflation come on about. And I've spoken to Don many times about this, or quite a few times, and it just seems that his time frame probably could be much longer from where it is right now. A lot of people are saying that the nasty inflation is going to be within 2 years. From what I've talked to him, it seems that he thinks that it could take, I don't know, maybe decades before we see this inflation. But he has told me he believes that we're going to see this nasty inflation. He's told me in one interview as well. Dow 80,000, gold 10,000, something like that. But his thesis was that in 2007, a lot of people were doubting him, saying that his thesis, by the way, was that interest rates would go down, and since interest rates would go down, the market would go down, because he looked at a bunch of data confirming that. And then a lot of people on Main Street were saying, hey, interest rates are going down, that should be bullish for the stock market. And now what he's saying is, since interest rates are so low right now, what you're going to see is rates go up, initially stock market go down, but then eventually that's going to create the stock market going even higher, confirming based on the data that he's looked at. But let's look at the Fed funds rate based on, and let's overlay it against some of these indices in the stock market, such as the Dow, the S&P, and take a look at that to see whether or not Don is correct in what he's saying. So let's now look at the Dow versus the Fed funds rate. And what Don Harold said in 2007-ish, right, when his channel was really big, right? He was as big as Greg Manarino. But if you want to look at this, look at the Fed funds rate and look at the Dow. Dow right now is close to 16,000 in the red, and then in the blue is the Fed funds rate. And he was looking at data from basically, it must have been the 1980s, right? Or we could just start from 99, right? He saw rates go up and stock market go up. And then look at this. Rates went down, stock market went down, right? Dow 7,000 in like 2003-ish. And then he also looked at the data from 2003 to 2007. He saw the Dow go up here, got to 14,000. These are just averages, by the way. And then the Fed funds ran up to 5.25. Dow 14,000, Fed funds 5.25. And then how he predicted this, he looked at the comparisons from the past, within the past, I don't know, 10, 15 years, and then he predicted rates would go down, which they did. Stock market went down. But now the trend has gone away from what it has done since like the late 1980s, right? Fed funds rate 0, stock market up. And now what he's saying is that this trend over here is going to continue on. So he's saying this is going to go up, stock market's going to go up. But initially you may see the stock market go down after the Fed tightens to a certain degree. And if you want to look at the data here, right, you could, I wouldn't say that they're proportional. I mean, you see the stock market go up, Fed funds rate going up, but you seem to see more proportion, or you seem to see more of a proportional relationship between the Dow and the Fed funds rate after 1999-ish, right? Over here, the pattern, well, you could say doesn't correspond to each other. It has no correlation. And you see a correlation here. Okay, now I'm looking at the S&P and the Fed funds rate from 1957 to 1979. I said that, you know what? It didn't seem to have a correlated relationship between the Fed funds and the Dow. I'm just looking at the S&P because the S&P, it went in the same fashion as the Dow. And if you look at from this data, you could see some instances where you see similarities where it comes to, I don't know, interest rates and the Fed funds rate, but it did not go in the same direction. I mean, when I showed you the graph for the Dow, they seem to be proportional here. And if you look at the S&P from like the 50s, you do see maybe some similar patterns. You see the Dow going up here, and then the Fed funds rate, it slowly but steadily went up. But let's just look at from like 57. You see correlated move between the Dow and then the S&P. And then you see it go down, then go up, and then down a little bit, and then it goes up, goes down, goes up. But see, they're not correlated to the extent that they were the other graphs. So actually looking at it broken down, you could argue that it is somewhat similar, not completely similar to the moves in after 1999, because then you see a significant move that shows how these two are pretty much related. So if you look at it from this graph, right, you could say that, yeah, for the most part, they tend to be correlated, but not exactly as it is currently, right, or before 2009, and from 1999 to 2009. So what I think is going to happen is, yeah, slowly but steadily, rates have nowhere but to go up, because they don't want to create nasty inflation, but in the process, they're just going to delay the day of reckoning, in my opinion, by keeping these rates artificially low for a long time. And what they're going to do is, how could I see the nasty inflation coming about? I've stated this in other videos. They're going to cut taxes. We have a dynamic economy. When we cut taxes, all of the money on the sidelines is going to come out, and they're going to lend it out, and because of fractional reserve lending, it's going to create nasty inflation. So do I agree with Don Harold that rates are eventually going to go up and going to create nasty inflation? Yes. Do I say that the Fed funds rate and the Dow, they're correlated? Well, at certain times they're correlated for sure, but other times they move in somewhat similar directions, not exactly the same. So that's something to note. Anyways, thanks for listening to me, guys. I'll talk to you later. Bye.